connection is the connection of computers, which are digital creatures, directly into the analog world that we live, both at the input end and at the output end. And in the 20th century, you tended to have human beings interpreting for the computers, analog into digital, and then from digital back into analog and acting on the real world. But in the last 10, 15 years, increasingly computers have interacted directly with the real world at the sensor end, using mixed signal, analog semiconductors and sensors, and influencing the world directly, changing it directly at the other end, robotics, automation. So direct connection is human beings setting these systems up, but then stepping back and supervising, taking themselves out of the loop. And if you take the human being out of the loop, you accelerate the processes millions of times. And if you can accelerate processes millions of times, thousands of times more applications become viable. So an example of this would be autonomous vehicles. So you could take the best autonomous vehicle software in the world, let's say an AI from Google, and you could put it in your car. But if it depends on me sitting in the driver's seat, looking out the windscreen and typing into a keyboard, I think the road is turning to the right a bit, that might be a traffic light coming up, is that a child? And at the same time, I've got a reader screen which says, turn the wheel 5 degrees to the right, accelerate, no, stop, stop, stop. The vehicle wouldn't even get out of the drive without crashing because the human being is slowing down the process so much that it becomes unviable. So there you can see that the direct connection of the computers, first of all to sensors, and then directly to the accelerator, the brake, the steering wheel, are what makes it potentially viable, and autonomous vehicles can therefore happen. So increasingly other sectors are beginning to act more like the technology sector. So in other sectors, if you don't act like a technology company, you're going to die. So the technology sector is essentially eating the other sectors alive. It's going from being an industry vertical like media, telecom, healthcare, insurance, to being an economic horizontal, where it powers what succeeds in every other sector. And essentially, it is sucking the growth out of the broader market and concentrating in one sector. I don't tend to try and pick winners outside the tech sector. It's not my area of expertise, but I feel that if, for example, two fintech companies are fighting it out, both of them are going to succeed by trying to act as much like technology companies as they possibly can. I don't need to pick the winner of that fight. All I need to do is pick the technology companies that are supplying them with the equipment, the software, the services, the hardware, semiconductors, or networking equipment that they need for that fight. So I can stick to the technology companies that I know and get the growth from all the other sectors, because both the winners and the losers in other sectors are going to be spending all the money they possibly can on technology from my sector. I don't really try and look for the next trend. I tend to sit on my direct connection stocks, and I feel the next trend tends to come to me, because long before I've heard what the next trend is, already the companies that are involved in it will be buying technology equipment. So if I sit on the companies that are, as far as I can see, best positioned to connect computers directly to the real world at the input or the output end, then I will tend to receive the benefit of that next trend before anybody has really even heard about it. The technology sector has been outperforming almost without a break for the past 9 years, and this has essentially been due to direct connection, amongst other factors. And in my view, it could go on for as long again. So I look for 4 things typically in investment. I'm looking for a strong underlying trend that benefits the company. The second thing I'm looking for is the ability of that company to create value from that trend. The third thing is barriers to entry, to stop someone else coming in and stealing that value away. And the fourth thing I'm looking for is a fair, reasonable distribution of that value between the various stakeholders in the business. Now, I find that most technology investors focus on number 1 and number 2. So they look at the trend, the top line growth, and they're looking at barriers to entry very sensibly, because you don't want someone else coming and stealing your business. But they pay very little attention to factor number 2, does the company create value out of that trend? And they pay almost no attention whatsoever to number 4, how is that value distributed between the stakeholders? And while 2 and 4 don't make a very big difference in the short run, don't appear to do, over a matter of a couple of years at least, sometimes much faster than that, they make a huge difference to how a stock performs. So I feel it's very important to look at value creation and distribution, as well as how fast is the company growing and how different are its products. So an example of investors not getting a fair share of their value, or the value created by a company, would be software as a service, on-demand software companies. So they grow very fast. Undoubtedly, the on-demand business model is very, very efficient, but most of that efficiency, the value created, goes to the client, the customer, which is why they grow so fast, because the argument for moving your software to an on-demand model is almost undeniable. It is so obvious. So most of the value is going to the customers. The value that is left goes to the employees, because there is so much demand for talented engineers and good salesmen that to retain them in a very competitive market is extremely difficult, and companies tend to reward them in shares or in options, and that share granting constantly dilutes the underlying stock count. And I've run a sort of back of the envelope calculation which suggests that quite a few of these companies are giving away essentially multiple years worth of free cash flow every year in terms of stock dilution. What is interesting is the number of years of free cash flow that are essentially given away to the employees to keep them coming back into the business. It's very tightly correlated with the distance. I measured it to the Golden Gate Bridge in San Francisco. It's a pretty good straight line on a log chart. Essentially what I'm saying there is that in San Francisco, the market for engineers is the tightest in the world. And if you're working for Salesforce.com and you aren't being paid enough, or you're offered slightly more, you can just go down the road and another company will pick you off and give you a better job, or another job paid much more generously than the last one. My investment approach can be summarized by looking for a strong underlying trend that a company can benefit from and create value from, and then I'm looking for a fair distribution of that created value between the various stakeholders, including outside investors, so our clients. And if you focus on the value creation and the distribution as well as top-line growth, you're capturing something that most of the technology market is missing, and that can create value for your investors over the long term. The problem with the high growth, very high profile companies is they are very expensive, and often they've got very fragile business models. So they may not actually create very much value for their external shareholders, and they are very dependent on improvements in news flow. So essentially, if the news flow doesn't go on getting better every week, these shares will underperform, and they are so expensive that they have a very long way to fall. So I find that the very high growth names typically aren't very satisfactory investments. You can't hold them for very long. You need to trade them on news flow, if at all. I'm also quite skeptical on the very largest companies, the mega caps, and I define a mega cap as having a market cap of maybe $100 billion or more. To become a mega cap, you've had to have an absolutely amazing 10 years. Both luck and skill have gone your way, and everything has been fantastic. In most sectors, that's a reasonable indicator that you probably have another good 5 or 10 years ahead of you. But in technology, that's generally not the case. It's quite unusual to find a tech company that stays right at the top of the market for 20 years in a row. So for me, if you collectively buy the mega caps, what you're doing is buying last year's disruptors, and you're setting yourself up to lose share to this year's disruptors. So I tend to avoid, I start with no mega caps at all when I'm building a portfolio, and then buy the 3 or 4 that I feel I have high conviction will do even better in the next 5 years than they've done in the last 10, and that's a pretty high bar for these companies. So my portfolios tend to be very underweight the mega cap stocks, and tend to be focused more on companies with a market cap of typically $1 billion to $100 billion. You can't really see Apple increasing its value by a factor of 5. There simply isn't enough money in the market to do that. But if you've got a $10 billion company and it gets it right, it can become a mega cap. It can become a $100 billion company. So you've got a factor of 10 there. So the scope for upside in that substantial range of very liquid names, 1 billion to 100 billion, is absolutely enormous if you can get it right. And that, for me, is the best and the most promising pool of investment in the tech sector. So in my portfolios, I tend to own fairly boring names quite often. My competitors and colleagues would look at my tech portfolio and think, oh, there's not very much of interest in there, is there? But what I'm trying to do is find companies which are benefiting in particular from direct connection, and where the value they create is very stable and very predictable, and the barriers are absolutely enormous. And if you find those companies that are right at the point that is required to enable direct connection, then you can just hold them for year after year after year. They'll be quite expensive because everybody recognizes they do something useful, but they probably won't be expensive enough to justify their importance in the market. So you can have a stock which can outperform for years without actually increasing in its valuation metrics. And I like those sort of names. I'd like a stock which I can buy and hold for, let's say, 3 or 5 years without really changing it very much.